I'm really excited for this talk, but I want to start with a quick question. Who here may issue a token at some point? Okay, that's a lot of people. So if at least half of that group does not ask me questions, you're insane. Like, you need to ask stuff. There's so much in this talk that I have omitted or glossed over or simplified because there's tons to talk about regarding tokens. They're complicated. I talk about them basically every day with our entire portfolio. I've been thinking about them every day for years at this point, and I have no idea what I'm saying. So if I don't, you need to have questions. And typically when I have this type of conversation with our portfolio companies, it's in the form of a conversation, a dialogue, where they have some thoughts, they have some opinions, things about their protocol, things about their product, and those things help inform what I can say and back and forth. So I have a bunch to share. I'm going to stop at a bunch of different points and say, are there questions? What do you think? If you want, interrupt at any point. There's mics going around and they're going to jump right in really quick. So let's make this as conversational as possible. Honestly, I think it has to be as fruitful as it can be. So first, what are we talking about? We're talking about tokens, a specific type of token, which I'll get to. First, I'm not a lawyer, so obviously none of this is legal advice. This is just my thoughts as an engineer and as someone who's seen this a bunch of times. Since a token is just a balance in a crypto program, that's really all it really is, there's many ways to do and to think about tokens, many that haven't even been invented yet. I hope you'll invent a few of them. But for this talk, we're going to focus on just a few. So first, let's start with meme coins, since they're back in vogue. Everybody's talking about them again. It's a little funny because meme coins have been in crypto since the very beginning. In fact, even before there was Ethereum, there were meme coins. And the way people would do them, they'd actually take the original Bitcoin code base, fork it, make a small change, give it a name, and put it out there. And if you go and look at like Wayback Machine and archive.org and look at captures of CoinMarketCap from 2013, you'll see the top 100 littered with them. Right? They're not a new idea. That being said, I hate to say it, I don't think they're particularly interesting. I hope that nobody here makes one. And we'll get into specific reasons why. The quick way to think about what a meme coin is, I think there's so much more to say, but they explicitly have no purpose. Right? That's actually a critical feature. They have to have no purpose, because if they have more of a purpose, well then it's something more interesting than a meme coin already. But also you start to get into protocol design, you start to get into legal questions. The fact that it has no purpose is what makes it a purely speculative vehicle. And it being a purely speculative thing is what makes it just gambling, which makes it legal, because gambling is legal, right? So those things have to kind of hold together. Obviously, because it's purely speculative, there's extreme price volatility, which is kind of the feature of the thing. It's not a bug. And worth saying, I'll mention later in this talk a meme coin example for a specific purpose. But meme coins can be decentralized, but they could also be a scam. Right? When I say a scam, I mean there can be deep asymmetries of information in the meme coin, right? Where some people have kind of arranged in advance they're going to dump like this or share the information like this, or allow maybe like there's hidden bugs in the code. It looks like a regular meme coin, but there's actually a backdoor or a mint or a mint vulnerability, something like that. In the ideal case, you could mint the meme coin and distribute it across a whole bunch of people, and you could say it's decentralized, and I'll think about it more in that setting. The other setting is really more of a scam. But anyway, I'm not going to say too much more about that. A second key token category that we're also not going to talk about is stablecoins, right? Maybe some of you will use them in your protocols. I hope you do, because I think they have a lot of promise, and I think they're critical for mainstream adoption. They've been taking off, as you can see, chiefly as collateral on-chain, and not so much for payment. But I think that that's likely to change, even though that's been something people have been saying in crypto for a long time. Hasn't really happened. But we can talk more about that later. A third category that people don't really think about as much, it has a bunch of names. I like to call them arcade tokens. Some people call them soft tokens. Sometimes they're the second token in a two-token model. This is a token that's on-chain and transferable, but it's typically price dampened in some way, usually as a result of the issuance and redemption mechanism. So it could have an functionally unlimited supply. Think of it like an arcade where you can get little tokens in an arcade to play arcade games, and they have a monetary value. You had to pay for them, and they have a utility at the arcade, but it wouldn't really be reasonable to buy them to expect price appreciation, because you know that the way they're being issued is very loose and very easy, and you know they have limited usage in terms of redeeming from maybe a single counterparty. The final category, which is the most interesting category, and the category the rest of this talk is about, for some reason people just call it token, but this is network token. You could call it a protocol token, right? This is the token that represents a decentralized protocol, right? It is the core, it's deeply integrated with it in some way, potentially has high volatility, but it's part of an economic model. And I'm going to talk a little bit more about that economic model and big picture. Examples, you know the examples because they're the biggest crypto tokens. Ethereum, Maker, Uniswap, Uni, Compound, these are all classic more developed examples that I'll refer to in the talk. If you don't know how they work, you should, and we'll talk more about that. A critical thing is that these tokens represent a larger system. You can't just make them in isolation. Their issuance and redemption and creation and destruction and their value capture and their controls have to be a part of a bigger thing. You don't really design a token, you design a protocol, and having balances and assets is part of the way protocols work. And this is an example of that. So are there any questions about this before we go on? Yeah.
Would you consider something like Fly a token?
No, yeah, eventually maybe. Right now, because it's off-chain and because there's no transferability, it's not yet. That's just a point, it's a balance in a database. But eventually, if it was transferable and if it was on-chain and it was part of a larger system, absolutely. And now it may, although I do talk with the Blackbird team a bunch, and I think that they're thinking about it really deeply. It could also end up being in the category of arcade tokens. Right? It could actually be a great example of that, where you go to restaurants, you could imagine paying with Fly, and you imagine they can do extra work to ensure that the Fly value, redemption value at a restaurant is more or less stable, and people can kind of take it for granted and reason about it, but that it could still have transferability, and there's a known on-chain process, or at least grand economic process, for how it's issued and how it's redeemed. So it could be in the arcade token.
I guess one follow-up
Yeah.
is like,
Yeah.
they released as points, centralized, not on-chain.
Yes.
Is this something you're seeing more teams doing?
Yes, and I think it's a good idea with some caveats. I'll say more about that later. I may refer to this a little bit in conversations, like, Hilmar knows this so well. In fact, one of the coolest slides I've seen was, I saw like the quant aggregations of the faucets and sinks for some really incredibly cool slide. But this is just a very simple mental model I think everybody should have in their mind when they think about the token. The faucet here is your ability to print the token. When you make a new token, there is a single power that you have. This is probably the most interesting power, single power, that a token has beyond programmability, is you can determine the conditions of its issuance. That's an unbelievably powerful ability, right? Because it means, like, take Ethereum as a simple example, it means that you can always guarantee that validators will be paid. Because there's no fixed pool we're pulling from. We will print the tokens, they will get paid, right? Now, that doesn't mean that you should have infinite issuance and massive inflation necessarily. It's just we shouldn't take for granted the power of this faucet. And I'll say more about what I think are good things for this faucet to come from, but when you print more tokens and you increase the floating token supply, great. Hopefully the protocol is paying for things that are very, very valuable and will expand the supply and quality of the goods that the protocol is supposed to make available. But you should also keep in mind the sink. And these are the things that eventually destroy or retire or lock up or remove from circulation the tokens that we're creating. And the reason why you need that balance is because you want to preserve the price of the token so that in the future, when it pays for things, it's paying for them with a valuable asset. Right? It's about creating sustainability in the end and creating a degree of equilibrium. That's hard to make that perfect. There's tons of caveats I have to say here, but just always keep that in mind when you're designing the system, that your fundamental power is issuance, but you need to always take into consideration the sink. and the sink should be tied to the good that is being created by the system, like the thing that is fundamentally valuable by the system. Another quick thing I'll say here is it's not uncommon to think of a protocol as a marketplace. Like think of it as having a supply and a demand side. So there's the faucet, there's the sink, and then there's also the supply. That's the parties or mechanism that is creating the thing that is a good that people want. And then there's the demand side of the market, which is where people pay to consume that. So to pattern match this against ETH very quickly. ETH, we pay the security budget to validators. That's the inflationary reward. The sink is when people pay for compute. A portion of that is paid to validators. A portion of that is destroyed in the EIP 1559 burn. So the demand side is demand for compute and storage and verifiable computation. The supply side is network capacity, block space, that type of thing.
Do you have any sort of mental models to kind of reason with, you could say, the inflationary and deflationary sort of economics of supply, or any
Say a little more?
the inflationary and deflationary sort of economics of the kind of supply and how that impacts the protocol? Do you have any sort of mental models there or any ideas around there?
So making a system that can achieve a perfect equilibrium is incredibly difficult. So I wouldn't endeavor to do that, especially from the start. I don't think equilibria are like real things in nature that are sustained always. I would say that I tend to think having a degree of inflation is good as opposed to a strictly fixed supply, because that inflation means you can make a guaranteed payment for something. And another quick one is the fee where you extract from the system should be at the point that the valuable thing is consumed. Right? So don't try to put fees or extract value from the system on like a weird part of the supply side or some like random like corner over here. Take it when people actually consume the valuable thing. So for Uniswap, they're consuming liquidity, right? They're actually paying for a trade. That's like the good. For Maker, it's paying for the leverage that they are consuming, the risk that they're creating in the system. They pay for that. For Ethereum, it's block space, computation. Those are very valuable things. So force people to pay for the valuable thing. Does that sort of answer your question?
Sort of.
Yeah.
I was also kind of sort of alluding to, you could say, back in the day, you used to have things like bonding curves and stuff like that that kind of played around with it. So did you have any sort of suggestions there?
Like whether to use a bonding curve?
Not per se, but mechanisms of that sort. Yeah.
Yeah, there's a whole toolkit of them. I mean, like bonding curves are good when you want to create a market where there's very limited liquidity and you're okay with the price schedule being some sort of fixed curve that might not actually reflect market demand, right? Like we can talk about those. Maybe we'll spend some time on it. Yes.
When you're measuring the impact of sinks and sink design, hey, thank you. There are obviously the official sinks that you just discussed, and obviously in like Ethereum, you can have unofficial sinks, contracts that send to dead or those things. How do you measure that ecosystem-wise?
Very hard to measure. I think of those as like explicit and implicit sinks, right? Explicit is like, you build the fee in, it's paid, it's burned, whatever. Implicit is people want to float some. People trust it, they want to hold it. They use it as collateral in some other thing, right? There's all kinds of sinks like that. I'd be weary about designing a protocol where you rely on the implicit sinks, right? Just because they're harder to quantify.
Yeah.
Of course, they can be very powerful, but let them appear in the backdrop, right? Try to measure them, but like let them appear in the backdrop. The system should hold together without you relying on those implicit sinks. Those can be very dangerous. And some things that seem like sinks are not. People will often say, I'm going to say in a few slides, like for payments, people use it to pay. Then it's a sink because they have a little bit in their wallet. Maybe, but how do you measure that? Should your system rely on this? Also it's a liability in a way because that sink could be depleted. Like it could back up immediately, right? It's not a real
Double
thing.
entry bookkeeping at that point,
Yeah, exactly. Okay, so here's some good and bad reasons. So these are really quick cuts. I could talk about these forever, but okay. So here's one. Incentives. This one drives me nuts. Sometimes people will come up and say, Eddie, I want to make a token. I'm really thinking hard about it. I'd love to make a token. And then I say, okay, great, what does it do? And they're like, well, it's going to pay for this. That is terrible. That is not a real, that's just printing money and then like throwing it somewhere. What you it's so easy to get caught up in the idea that you can make a token, you can pay for a thing. It's like having an infinite ad budget that you didn't pay for. This is not a real protocol design. And worse, it will create huge issues for your reasoning about the system, right? Your goal as an entrepreneur is to try to find product market fit. You're making a product and you want to ensure that it's a thing people actually care about, that they actually want to use, that they're willing to pay for, because you're creating more value than you took as inputs. If you just spend it on the wrong incentive, then you can end up distorting your ability to read the product market fit. And it's like if someone says, yeah, look, I have like 5 million in revenues, I'm feeling really great about things, and you check underneath the hood and then their ad budget was 20 million, right? You would just know that there's nothing real underneath there because they're paying for it. Now, thankfully in that case, in a traditional company, it would be on the balance sheet, so you could see. But in crypto, if the token exists somewhere else, it can be very, very hard to measure. You'd be surprised how little work people do to try to quantify how much they're actually spending on customer acquisition costs indirectly through some sort of token incentive plan. So I'd say it's not that you shouldn't use the token to pay for things. You should use it, and a good protocol will use a token to pay for the right things. But if you just think of it as a way to blast money in a specific direction, you are not going to learn the most things, and you're not going to create something of long-lasting value that outlasts a single hype cycle. So there's so much more to say there, but instead what you want to do is you want to pay for network effects. You want to grow the network effects of the system, right? Now, it's hard to make sure that what you're paying for is valuable, that the supply that you are hopefully bootstrapping the development of is real supply that you need more of and that is good and works. But there are ways to do that. The first yield farm, as far as I know, was Compound back in 2020. And they would pay for supply by just giving people a little bit of token when they deposited one of several collateral types into the protocol. That's a pretty simple one to verify because you know what the collateral is and you've hand-picked what collateral types are being used. So you can know that it's useful collateral and has value, and you can pay for it accordingly. And that's all the system needs. But if you think about your protocol, what are the things that are critical to developing a network effect? What is the supply side? What is the demand side? And how can we boost high-quality supply? Right. And as I said before, subsidizing demand can make things a little bit more complicated. So be very, very, very careful with that. Right. What you really want is the things that lead to the accumulation of a network effect. Another thing you want to pay for, which doesn't apply to all protocols, but it applies to a lot more than people think, is security. You want to pay for security. Now, when I say security, I mean in a very, very general sense. I actually thought about trying to pick a different word for this, but it's hard. Ethereum proof of stake pays for security. Right? There's a token issuance that pays validators to do the work to make sure that the block space supply is high quality. That is what is happening. They are all making sure that the block space is good, that the compute in the block space was paid for, is correct, and is replicated across the system and verified. That's at the infrastructure layer, but you could also think about this at the application layer. This is what's happening with Compound and with Maker. When they pay regularly for security. In the case of Compound, what security is, for those who don't know, because everything is layered into a single pool, there is always a risk that a collateral asset that is dangerous or low quality gets added as a collateral asset to the pool. And that's very, very risky because if garbage collateral is added, someone could deposit a bunch of garbage and take all the things that are valuable. So the protocol is specifically designed to protect the deposits in the pool. That's what it's doing at all times. The Compound token holders are voting carefully on the admission of new collateral assets, on the debt ceilings of collateral assets, and their goal is to ensure that suppliers never lose their collateral or the deposits, and that borrowers pay their fees and pay their debt. So it's making sure that the thing is secure and it does exactly what it promises, that the ability to deposit and to get leverage out of the system is very, very, very secured, and that it behaves as guaranteed. This is a kind of security, and the token exists to ensure that that security is delivered. The same is true with Maker. And I think I was talking a little bit about Story Protocol earlier. Without going into the details of how it might work, if you had a network where there are various intellectual properties that you could commercialize or make a derivative works from, you could imagine a very critical concept of security would be that the intellectual property that I'm commercializing is a legitimate intellectual property. That's a very hard thing to measure. In the real world, you have to do a lot of legal work and a lot of diligence to ensure that that is a real, legitimate intellectual property and the person who says they own it actually own it. But if you could take that for granted, if the protocol ensured that this degree of legitimacy was true for all the assets in this network, then that would be a very high quality product. And I could say that about any application in crypto. The product guarantees verification, credible neutrality, and if you can pay for that with your token, then that is a very high likelihood of being a long-lasting and valuable protocol. I can say a lot more. I know there's a lot, but are there any questions about that or any thoughts? Yeah.
Let's like dream up what your like protocol's like perfect world and all the things that your protocol needs, and then budget it out in your like supply, and then try to go pay for those things, and that's your budget for all the hard things your protocol needs.
Yeah, but I'm saying, like, what is your protocol selling? Like
Yeah,
that's like the question. Like, what is your protocol selling? What is the thing when someone comes up to it, they're going to say, "But is this good? Like, is this true? Is this high quality?" And pay to ensure that it's high quality always.
Yeah.
Yeah, and that it's and high quality is my colloquialized way of saying verification. Like verification is a boring word, but that's what's so exciting.
Got it.
Okay, thank you. Was there another question? Yeah.
Do you think security, the way you define it, is inherent in the value of network tokens?
Say more.
The way you're defining these network tokens specifically, it kind of seems like security is actually a key piece. Like you can't have a network token where you're not paying for security.
You can't. So I'll give another example. My next example doesn't have it, but the point is that the network token should pay for security. The network token's value comes when people pay for that thing that is secured. They're consuming it. The token should capture some of the value from that to sustain its own price so it can keep the system going. It's all about making the thing perpetually sustainable. And then also, some systems create risk, like with Compound, with Maker, they have systemic risks. And those risks, instead of being spread across the users of the protocol, can be internalized into the token holders, so they absorb the risks. And the nice thing about pushing risks in there is you can pay people to do it, right? People should be paid to take risk, and when they take that risk, and they can do work to mitigate it and ensure that it continues to work. Now, some systems don't require paying for security continuously, right? So, for example, immutable systems can have very, very low security costs. So take Uniswap as an example. I hope people have been thinking a little bit, but wait a sec. This describes some of these, but this doesn't describe Uniswap, right? It doesn't. Uniswap is totally immutable. Each version is separate. It does not have an ongoing security budget, and it doesn't need that. And that's because just a property of Uniswap's design is that it externalizes security concerns. Each Uniswap pool is separate and isolated. And the trader who goes and swaps something in the pool is the one who accepts the risk of the pool, right? And because of that, you don't need to pay continuously for securing. There's no systemic risk that needs to be carefully monitored and paid attention to. But not all protocols can be designed such that they're immutable. For example, you could not do Compound with immutability because it needs to be able to decide which collateral assets are safe because of the way that liquidity is shared across assets. And so if you can make the system immutable, then you save a significant cost, and you may also be able to minimize or eliminate governance altogether. And if that's the case, I think that's a great idea. So here's another bad reason people make tokens. They say it's for voting. This is like a governance token. Who wants to vote? Like, what is the point of that? To me, voting, it's not that you shouldn't have voting in the system. Voting is a last resort. This is true politically in a way as well, right? Not to get too crazy, but voting is a last resort. In other words, we don't have a way for society to organize itself properly at the appropriate organizational level. So we need to do the most painful conceivable thing that is expensive, difficult to analyze, low signal. Like it's very, very, voting is very, very, very cumbersome. We go and we ask everybody to weigh into a potentially incredibly nuanced, complex, multidimensional question. You should only do that if you really, really, really need to. And the evidence so far is that token governance has relatively low participation. It has high opportunity costs. It's difficult to motivate experts to do the research. It's not that it's totally dysfunctional. It's just that it's a cumbersome, slow thing, and you should apply it only when necessary as a last resort, and everything that can be automated and built into the system or delegated to a market mechanism or something like that ought to be. And worst of all, if that's the story for why it's valuable, like you're telling people, well, why would people want this token? Oh, well, they want to vote. Well, you're just deluding yourself. No one wants to vote. The voting is part of the responsibility of being a token holder. What you really want is you want to align the network. You want all the stakeholders of the system to be incentivized and to think toward the same goal. There's a ton to say here. I think this is an incredibly powerful property that tokens have. It's very, very difficult to achieve with equity. But the fundamental idea is that you have adjacencies, like these are goods that are next to your product that are important for the functioning of this protocol. You have suppliers, you have users, you have technical partners, all these types of people. You can make deals with them, but you know what's even better than making a small, simple cash deal is they have tokens. And now they want the protocol to succeed too. And you can create links between all these different adjacencies that otherwise might be competing. And the thing together is now much, much, much more potent than it would have been otherwise. Right? There's all kinds of tools you want to deploy in this setting. Vesting, milestones, locking. I'll say more later, but you can imagine some of these methods being automatic and some of them being manual, like in the early days. Manual being like BD deals, partnerships, conditional token swaps made out of your foundation, things like that. They can be automatic, like people deposit collateral, they lock it, they have to promise to do some verifiable work, they get paid if that work's done, what they earned unlocks over time, et cetera. We can be very creative with this. I think people really underestimate how potent this is and the effects we see because a lot of the most pronounced effects are subtle. Right? They're just people agreeing with each other, or people not competing, or people sharing open source code, or people promoting each other's products on social media, right? Which is like a very important part of how crypto has developed. So happy to say more about this. This one's kind of on the fence for me, and I just mention it because it comes up a lot. People bring it up a lot, is payments. Like what my token is for payments. Remember, I'm talking about network tokens. I'm not talking about arcade tokens. I'm not talking about stablecoins, right? I'm specifically talking about the protocol token. The evidence so far is that people don't want to pay with protocol tokens. In fact, there's friction in doing so. They have to get a balance of it, at least the way networks work today. They have to secure some. They also have to reason about the risks of holding a potentially volatile asset. People don't like paying with a volatile asset. Even if they think that if they think it's valuable, they may not want to sell it. And if they think it's not valuable, they probably don't want to hold it and have a whole stock of it available for payment when they need to. It's not that I think it's guaranteed not going to work. I think that it could. Just we need a lot of interesting evolution in how to think about these tokens for it to work. So it's a little fuzzy. And then like last point is that if payment is not a clean sink. Now taking a fee out of a payment can be a sink, right? But the payment itself, requiring people use the token for payment, is not a direct sink. So happy to say more about that. Any questions so far about some of these high-level good and bad reasons? Yeah.
Thanks. How do you see the potential of governance to actually help with security? So like in the case of Compound, that was kind of clear, right?
Yeah.
So that's not necessarily like a bad thing to have governance if, the decision how to secure the network cannot be automated, but has to have maybe a human in the loop. Like, okay, we're gonna decide that this token pair is safe enough for us to put us into the collateral pool.
So it's true. Obviously, that's what's happening. The token is for voting for security. I think it can achieve that purpose, and there's evidence that it can work, right? Maker does that, Compound does that, Aave does that, bunches of DeFi protocols do that. There's also security councils, literally, right, where there are people with a special power to freeze the system in the case of an exploit or something like that. So it can definitely be the case. It's just very sensitive. You're introducing a point of failure. You're introducing a political risk, right? You have to really think about how you're designing that. Compound and Aave and Morpho have all lending protocols with an overall similar purpose. They have spent a ton of energy thinking about how to get experts to vet their protocols with every change. They have to pay for it. They have to ensure that there's at least some number of experts, that they weigh in publicly, that they're constantly being evaluated, that their token holders are evaluating them. I'm not saying it's impossible. It's just, this is a pain. Can you do without it? Can you minimize it? Right? To the extent to which you can minimize it, you're making the system more robust. Right? That's the frame. And of course, I don't think it can always be removed in all cases. But yeah, does that answer your question?
Yeah, no, totally.
Yeah, totally. Yeah.
So sorry if I'm oversimplifying it, but like, it sounds like a lot of it is like bad incentives, bad, good incentives, good. Right.
Yeah,
like,
sure.
So like,
Yeah.
how do you turn that from something
bad money bad, good money good? Yeah. I mean,
but how do you turn it from something that's kind of more subjective to something that's more objective, right? Because if you're saying, hey, like maybe I'm spending 20 million on marketing today, but I'm only bringing 5 in, then that might grow over time. Like, is there any way you suggest to like kind of measure that more objectively?
Yeah. So it depends on the thing. So like in the marketing example, if you're spending 20 million on marketing for 5 million in revenues, then the question is, what's my CAC LTV ratio, for example, right? Like I'm paying for customers, and then I'm getting this many revenues from customers. If that ratio is underwater, in other words, you're paying more than you're receiving, then you know something's broken with your CACs, and you need to lower your customer acquisition costs. That's like the sort of basic like marketing playbook. Now in protocol design, you have to think about what you're paying for. So I'll give you a very crude example from like earlier in crypto history that people may or may not know. I don't know if anybody remembers Steem, STEEM, from like a very early. I love it. Yeah, so that was around. That was kind of an early social network. It wasn't decentralized, the social network, but what was the kind of critical conceit was that people were paid for comments. So like you made a comment, and then you would get like paid in some token automatically for that comment. And if people liked your comment, you would get more payment. That's it. It was just that simple. So if you're thinking like, wow, that seems really broken and I could easily exploit that, you're right. Right? And what ended up happening is that there was a huge amount of comments. The system was constantly going down because it was flooded with comments, and the comments were garbage because we're paying for comments, not good ones. Right? So in that system, the issue would be that the thing that you're incentivizing is not the thing that you wanted. Right? So that's why a critical piece is verifying the quality of the supply. That sounds like, oh, maybe that sounds easy, maybe that sounds hard. It's hard. It's incredibly important. And if you can do that, then you can feel safer about subsidizing it. Right, so to answer your question is like, how do you get concrete on like what you're incentivizing? Incentivize things that you can verify to some extent as automatically as possible, their quality, and that those things directly lead to high quality network effects as opposed to vanity metrics. Like a bad thing to incentivize, people making random ass transactions on my network. That doesn't help anybody. There's no point to that, right? What's a nice thing to incentivize? High quality supply of high quality conversations. That's harder to measure. High quality capital deposits. That's easier to measure, right? Yeah, does that kind of answer your question?
Yeah. So like just the last part, basically like combining simple marketing metrics with what you're trying to achieve with your actual product.
Yeah, but also it's not just marketing, right? It's security, it's liquidity, it's whatever the good is that's being created by our system. So it may or may not be marketing. Yeah.
Thank you. I'm curious if you think it's should you design a protocol around the incentive or like the thing that you want to pay for, and how do you think about designing around that incentive changing over time in terms of the application and the use of it and like what you're trying to incentivize?
The incentive changing over time, or the thing that you are wanting, the thing you want to grow more of changing over time?
Exactly, yeah. And like just how you think about,
Yeah.
yeah, you got it.
Yeah. So this is why I really like manual programs as well. Like doing an automatic program is critical if you want it to be truly decentralized and sustainable. Because the goal, as I'll say more about in the path to decentralization part, is you want to be able to walk away from the system and it still works. That's like a great little test. So obviously that needs automatic payments to sustain the thing. But in the earliest stages, you should aggressively use manual allocations of tokens, right? To bring on the right partners, the right contributors, whatever. And the things you incentivize in that case ought to change over time because you're learning more. The point is you're trying to find product market fit. You're getting signal from the market continuously. You're learning about what's working, and you're realizing, okay, this is a new bottleneck. This thing solved, here's my new issue. This thing solved, here's my new issue. You should definitely be adapting what you're incentivizing to the extent that you can verify it as well. Yeah.
Yeah. One thing that we haven't touched on is DAOs. And so the playbook we see a lot in our niche is people use a token as a money printer and then justify that as voting. So they basically do all the things that you said not to do.
Exactly. Yeah.
And the voting is for part of a DAO. What do you vote on? What can it do? Very dubious.
Yeah.
Can DAOs be done correctly? Like, do you see? Okay.
Yeah. They can be. I mean, how much to say now? I mean, I guess. Well, one thing that's helpful, like when do correctly, there's like a couple parts of do correctly. One is legalistically.
Yeah.
If you haven't looked into it or learned about it yet, I think it's going to be in the curriculum is our DUNA framework that we're recommending people take with DAOs. This is like a legal entity in the U.S. that you don't have to be in the U.S. to take advantage of it. That can serve as a much more appropriate alternative to a corporation.
Right.
For DAO members. And what it does is it allows them to vote and to have like express opinions that are legalistically binding and real and protect them from liability in such votes and do things like pay taxes and be compliant with the law without there being like managerial controllers of the system or being like a formal corporation where people are hired and fired and so on. So first, that helps a lot with that leg of doing a DAO.
That does.
A lot of the DAOs that are trying to do their thing are not doing it right because they're completely avoiding that angle and taking a lot of unnecessary risk. The other side is, what is the purpose of the thing? Well, like I said, just paying for stuff and then voting is like ridiculous.
Yeah.
That's not a thing at all. In my opinion, a DAO should be a group of stakeholders of varied interests who are the representatives and humans associated with a protocol.
Right.
So the story is, what's the protocol do?
Right.
For Uniswap, which is simpler because it doesn't have to pay ongoing for security, but it does collect fees. These are the people who hold tokens, use Uniswap, build apps on Uniswap, are all around its growing ecosystem.
Right.
And they have shared interests that they would like the protocol and the foundation to represent and to carry out. And that makes a ton of sense to me as a DAO. Now, whether they're doing it exactly perfectly right or not, like it's hard to say, but they should be able to allocate from their treasury. They should be able to support specific programs. They should be able to do things like make specific protocol upgrades and so on and so forth.
Right, that makes sense.
Yeah.
And I guess in terms of, is there a way to defend the DAO from voice influence being tied solely to how early you were? Is that something you should try to avoid against?
Oh yeah, that's a great question. That's a great and more subtle question. I think naive. I had like one line in here about that, which is like naive token governance, like simple token governance.
Yeah,
it's just like it's not that great.
Right.
Like, I just like, okay, you have these tokens, you vote now. Okay.
Yeah.
There's just like there's way more we can do that's much more interesting. You can have like different houses of votes. You can have automatic committees. You can put Sybil resistance mechanisms and then do like sortition, right, where people are randomly selected. I mean, there's so many creative, interesting things. I could talk all day about ways to appropriately govern. I think just taking how much token people have is there's advantages to it. Obviously, you want. I mean, I'm not like some radical where I think that that's bad. Like, people who have more stake in the game should potentially have more voice, right? But the goal is to try to get high quality signal about the entire ecosystem, and that's a complex and very subtle endeavor.
Yep.
So yeah.
Thank you.
Yeah, sure.
I'm not sure if I can express this properly, so I'm going to give it my shot.
Yeah.
Right? We were talking about, the value of tokens are what is securing the network, the protocol in this case. So in a case like MakerDAO, where they have two separate tokens, one for utility and one for governance, like they're obviously decoupled, right? But there's also the idea of, hey, is there a need to have those be decoupled in the first place? Could the people who are staking just use the native currency themselves to stake rather than have two separate things?
Well, in Maker, there's two tokens because one is the product,
right,
and one is the network token.
Right.
Right. And I would say it's not a utility token. I would say it's a stable coin. Well, if you're a user of it, it's a stable coin. If you produced it because you took leverage out of the system, which is one of the products, then it's a debt coupon that you need to purchase back to repay and reclaim your collateral, right? So it's kind of this sort of dual purpose token, sort of there's subtleties in it. Ultimately, the idea, and this is a really nice product design decision that I think it was great from the Maker team, is that you could imagine they have like the DAI holders vote. You could imagine the DAI holders have some responsibilities. But I think what they did is they said, let's simplify the social contract for the DAI holders. They can assume that the DAI will be stable. That's it. What are you getting when you get DAI? You get a stable token that is worth $1 each. And that's all you need to think about. And if there's a problem, that's Maker token holders' fault. They're the ones who will get burned if something goes wrong. You don't have to worry about it, right? And I think that's really important because if you're just using it as a stable coin, you don't want to think like, oh, it's a stable coin except for these complex caveats, or I have to like track some obscure like debt rate or whatever, insane things. So that's more of a product design decision, I think, and I think it was a good one. Cool. So a little bit about the path to decentralization. This little chart, okay, the vertical axis is decentralization with more decentralization at the bottom. And the horizontal axis is protocol functionality, with more on the right. So our goal, of course, we want to get to the bottom right corner. Right, why do we want to get to? We want to be really decentralized, and we want a protocol that really like does its job. Like it has rich and high quality functionality. Now, should I motivate more like why we want to be decentralized? Is that like, I'm feeling like maybe I should. Should I? Is it obvious why? Like, raise your hand if it's really obvious why we want to be decentralized. Wow. Okay. Well, 60%, 70%. Okay. Well, then I'll say a little bit about why we want to be decentralized. Decentralization is part of the product. I know people say, oh, people don't care as much about decentralization. I totally get it. But that's end users don't care as much about decentralization. This is like end users don't care about the specific idiosyncratic reasons for monetary policy with their dollars. Of course, they don't care about that. Why would they care about that? They do care, though, that their dollars hold value. They care that their currency doesn't inflate away. They care about that their bank doesn't steal their money, like all these things. People actually care about a lot of these things, and they make those choices, and those choices are reflected in their market choices, like what they choose to use and what they choose not to use. People like decentralization because they like there to be a lot of high-quality products. And if the thing that you make is very decentralized, many people will build on it because it's the most solid foundation. I can talk more about this at length. I have like another talk about this, but I'm presuming that decentralization is a critical goal. And if you want to issue a network token, it needs to be decentralized. That's the goal. We want it to be decentralized, and we want robust protocol functionality. So our recommendation, and this is kind of, you've heard about progressive decentralization, is that you start in this corner. You start at the top right corner. So this is the centralized but functional corner. Now, it's not safe to release a token yet. So I'm going to say, what we want to do is we started our good start, and then the things on the left, these are like not an exhaustive set, but like examples of things that as they happen, we are probably becoming more decentralized, right? We have diverse stakeholders. We have more economic activity from more people. There's alternative clients. The system's permissionless. We've minimized single points of failure. Like, these are a constellation of properties that are starting to describe a decentralized thing. And as we become more decentralized, then we can get closer and closer to having a transferable token. So at the beginning, when we're centralized, if you release a transferable token, you're taking extreme legal risk. Extreme legal risk. But as it becomes more and more decentralized, those risks diminish slowly. I'll have a little graph about it in a second. And you can do things like points. Points are great. Why are points great? Because you can incentivize things without risking people being burned. When I say being burned, I mean someone goes in, they buy a ton of a token, the price tanks because you tweeted the wrong thing. Now they're going to sue you, right? And the SEC is going to have a lot to say. And that's obviously a scenario we want to avoid. So the way we can avoid that, well, we make the token non-transferable. Now people can earn a thing. Yeah, it doesn't have a market cap. They can't reason about how much exactly it's worth yet, but they know they're accumulating something, and people actually do respond. There's significant empirical evidence that people do respond to these types of incentives. Once it becomes more decentralized, maybe there's a point where we can make it transferable. Maybe we have to keep the team and the foundation and investors locked up, which we probably should. Long lockups are good. And but then we can allow people who received it in an airdrop or people who received it for doing some good work, it can become transferable and a market price can form. Yeah.
What about a testnet? So
Yeah.
doing all of these, like the full functionality with transferability and so on, claiming it's a testnet, and then once you're ready, okay, now we're doing the same thing and kind of transferring the balances onto the mainnet.
Yeah. Well, if you're transferring exactly the same balance, then was it just mainnet all along?
Probably.
Right? Yeah. Don't be too cute, right? The cuter you are, the more risk you're taking, in a way, right? Because if it was secretly mainnet, then people can still be burned, markets can still form. This is a very subjective and hard thing to convey. And remember, I'm not a lawyer, but a lot of what it comes down to is how does it look? I don't mean that to be glib, right? I mean really were you facilitating the formation of a very dangerous high-risk market where you promised people money and you took their money and they lost it? If that's what happened, they're going to crush you. It doesn't matter how cute you were being about, no, but I said the legal magic words at one point. It doesn't matter. If you really were trying to do the right thing and you're earnestly progressing in the correct direction, and you're making that clear, and you're being honest, and you're not being crazy, and telling people nuts things, and the facts basically show look, business is hard. Making a business that works is hard enough. Making a crypto protocol that's decentralized and works is even harder. Then the facts will paint that. And even if you were in some gray areas at some points, as long as the intentions were extremely clearly good, and you went out of your way to try to avoid harming people, then you're probably in a safer spot. And I'm not suggesting the laws don't matter. I'm just saying I'm actually saying the spirit of the laws is very important.
So I guess what you see in networks launching today is that you have a testnet where everything is functional and possible and transferable.
Yeah.
And then you might not have one-to-one transfer of the balances to the mainnet, but you do have airdrops which are highly correlated with what happened on the testnets, right? So it's like an indirect way of doing this.
If the thing that people have to do is real work to earn that airdrop in the future, and you're saying look, here's your points, you did some real work. Well, that's not an investment of money. That's it's not. They're doing legitimate things to help build the network. That's totally clear. If at the other extreme, the way you're giving points or whatever is you say, hey, transfer me a shitload of money.
Right.
Basically, make an investment. I promise I'll give you these bunch of valuable points later. That just sounds like a sale, right? You see how it's not it's the full scene being painted that is what matters. Here's the simple test for decentralization. The simple test is if you disappear if your team disappears, if the token issuer disappears, whoever, the key party disappears, what happens to the token price? If the token price would go to 0, if you disappeared, you're not decentralized, right? If the token price would go to 0 with a single failure, that thing is unlikely to be decentralized. Now, if there's nuance, and it depends how people think about the token, I said the optics really matter, right? So if the way people think about the token is not as an investment, if they think of it in a more diminished way, and there's good reasons why they might think of that, then there's a gray area. But this is a simple, little too reductionistic in certain settings, but a valuable test that I think you should consider. Okay, so you might say, like, Eddy, why are we going from the top right to the bottom right? Why don't we just start at the bottom left? And I've actually been asked this question many, many times. Like, can't I just launch a meme coin? Meme coins are legal, right? Like, they're just gambling, but they're legal. Like, with caveats, they can be legal. Why can't they just release the token and then just go right? Layer on and add functionality later. The reason is a little bit complex to explain, but I think is really, really clear. The first is that this is how much legal risk approximately you're taking. So this is like red at the top with gray in the middle and then some green kind of at the bottom right. This is very roughly how much legal risk you're taking with a token, if you have a token at these stages. If you're centralized, very, very, very bad. If you are more decentralized, it gets better. And what's even better is if there's rich protocol functionality and you're decentralized. Now, this is the difficulty in finding product market fit. This is a really critical point. Okay? If you're totally decentralized, how are you going to find product market fit? You have like 95% of the people who use your system to convince to try that one experiment that may or may not work. That's just not realistic. I would say it's basically impossible if you're decentralized to find product market fit. Finding product market fit is easier when you're centralized because you're in control. Like this is what entrepreneurialism is all about. Is you're in control. You can continue experimenting. You can keep moving things around until you feel the pull of the market and it tells you like this works. This is a valuable thing that we want. So if you kind of overlay these on top of each other a little bit, right? You can see there's a clearer path, right, where you can go from finding product market fit while centralized and go down while maintaining product functionality, which you decentralize one at a time, because you found the functionality that had a product market fit, and then trend toward decentralization. With the meme coin example, the interesting thing here is if you launch that meme coin, and it's a legal meme coin, and there's no, you did everything right, you might say, okay, can I just wait a little while, and then later, like try to hook them up and find product market fit? The minute that you benefit from that meme coin, like selling it in bulk or in, or making a promise, like I'm going to make a protocol that uses this meme coin as its protocol token, as its network token, you are moving way back up the decentralization axis. So you may have literally moved from a safe zone back into a danger zone. It is not a one-way passage. You don't go and become decentralized in your commodity and guarantee that you'll never be a security again. You can re-secure. You can become a security again, right? So there's a lot more nuance to say here about like cute schemes where you convert meme coins into network tokens, but I think that they're really, really, really challenging, and there's a reason why we recommend this path.
I'm just curious, like a lot of this talk, right, is around, how we design a token and the approach and all that. But when you're building out a product, like when is the most successful, like examples of when people start to actually consider doing this? Like, is there like a point where you look at the company?
When to consider issuing the token?
Like when you start to actually consider token design and issuing a token, is there like a point where you look at companies and you're like, this is a really good time for you to now start to actually consider these things and move into this category?
The earlier the better.
Yeah.
In my mind, you're really designing a protocol first.
Yeah.
And then you're seeing where the role of a token is necessary. And the truth is, I think with no exceptions, when you complete a full thought of a protocol design, and this is how the system works, it's obvious where a token ought to be. In fact, it may not work without one. There's a pattern where you can make a protocol that's here, and then you can have a centralized app and business here. There's no reason you have to like only do the protocol. In fact, something that Chris Dixon likes to say is like a little pattern I think is useful to consider. Imagine if Coinbase made Bitcoin, right? They could have made Bitcoin. Obviously they didn't, but you could imagine the first exchange saying, you know, hey, I'd love like a digital asset that people could trade, blah, 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 blah. They come up with Bitcoin. And it is Bitcoin as it exists today. Like it's totally permissionless. It is exact like open source, all the things that we like. And maybe they're one of the early miners and they like get a good amount of it. But it really belongs to everybody. And it just goes out there and it's a truly decentralized protocol. But then separately they have a business that's a traditional real business that is a client of that protocol, right? So your business is an adjacency, right? Think of how like they're complements together. They do better together. I think it's a very compelling and reasonable playbook to say, hey, I have a company I'd really like, but I really need a protocol. Or I have a protocol I like, well, but I can think of a company that I would love to be a client of that protocol. And to develop them together, push them out, let the protocol become its own thing that controls its own destiny, like with the Uniswap Foundation, which is like authentically independent of labs, Uniswap Labs, which developed the protocol originally. And they may go in different directions. They may even compete someday. Like, who knows, right? That's good. That's like the crypto way. So I'll say that. Any other questions about this?
That's definitely a path that we're trying to go down. So curious, yeah, who besides like Uni and maybe like DYDX have you guys seen that have done that well? And obviously bodes super well that like they both came out of A16Z, but curious how like who else has done that well in terms of having then a centralized business that can, you know, have revenue that drives value to the equity. And if people ask you, oh, is the value going to the equity or the token? How do you answer that in a way that makes sense and is really both?
Yeah. So there are some other early examples we can talk about offline. But in terms of answering that second question, just because I know I'm running out of time, answering the second question, the reason why when we invest, we prefer both, right? The token warrant and the equity. In most cases, there are exceptions, but in most cases is not because like we just like want everything. It's because we want to preserve alignment with you, and you should make that decision later. It shouldn't be a constraint on the entrepreneur. Like you're going to figure that out. There's many cases where they thought it was going to go one way. We thought we were just going to make a protocol and do a token, and the equity was like a vehicle to make this thing, and the company goes away later. And then they decide like, no, actually there's like an adjacent business that we would really like to run. And vice versa, right? Where they decided, the equity turns out not that interesting. Like we want to be one of many companies that are building on this protocol, right? So in the early stages, I'd say leave your doors open and figure out what works. Finding product market fit is hard enough. Don't burden yourself with some commitment in advance. Let yourself wander around and you're going to learn as it develops. So I'm going to kind of rush through this last section here, and if there's any questions, let me know. So first, this is a hypothetical token launch schedule. There's a lot of info in this, but this is to say, like the way it's set up, it takes at least at a minimum, I think this is a pretty aggressive schedule, takes 6 months to launch a token. Like why does it take so long? Besides protocol design and the network selection and implementation of various protocol code, which should happen far before the 6 months before the token. Hopefully that's happened for a long time, maybe a year or 2 years, 3 years more, right? Who knows? But in the last 6 months before token generation and the launch, you have conversations with exchanges to have, security audits to do, conversations with institutional custodians. You have to worry about employee custody, team custody. There's foundation setup, governance setup, the DUNA filing. There's tons of work to do. Maybe conversations with market makers, analysis for like airdrops and other manual token distribution events. There's a lot of work. You can take a look at this. It's obviously just a hypothetical. No two have been the same, and yours will vary. But this is just to get in your mind that issuing a token, it's not just you just deploy on mainnet and you're done. There's a whole bunch of stuff to it. Thankfully, it's becoming a lot clearer, and we can, I can help answer some of your questions on that. But anyway, I'll leave that at that. And then I don't have enough time to go into extreme detail here, but there's only 4 categories of ways to distribute tokens that I can tell. Maybe I'm wrong, I don't know, so tell me if I missed something, but there's only 4 buckets. The first is token sales, selling tokens to people. Selling them privately to investors, no problem, right? The law is very clear that that's totally okay. Selling to the public, big problem. Don't sell your tokens to the public. Don't do it. It's one of the single riskiest factors you can do, and just don't do it. Placement. So this is, you see I have a little warning, like warning mark or whatever. When you issue a token, especially if your token is part of a protocol that's supposed to be functioning, people will need access to that token. People will want to be able to buy and sell it. Obviously, people who are performing the work for your system will want to be able to sell it, potentially to pay for their operational costs, if there are some. And obviously, people who want to be future contributors to the system or be a part of the thing will need to buy tokens. So they're going to go to a market, and you want there to be a reasonably mature market. A market that has no liquidity is a volatile, crazy market. And if it's volatile and crazy, you're telling a very bad story. So I'm condensing this story into its minimum time frame, but it's worthy to keep in your mind. When normal companies mature and they go through the IPO process, that is a long time period where they are vetted in many, many, many ways, and they need to survive long enough to get to an IPO, right? They've reached a degree of maturity where the market and underwriters have deemed them far enough along in their journey that it's worth IPOing generally, right? Obviously, they can still be extremely risky, but they're further down the risk curve is the point. People don't see how startups are brutal. A real startup is a roller coaster where the valuation of the company is constantly going up or down based on the whims of the next deal. So if people could see it, they would see that a normal startup is like incredibly turbulent chaos, but over time, hopefully, is maturing, and then maybe reaches a point where it's a little bit steadier, and it's still fluctuations, but a little bit steadier. When a token is released early in the history of a protocol, everyone gets to see that roller coaster. And worse, the market generally gets to participate in it, which means that the token price is now a spectacle that everyone can participate in. And what's funny is if you think about it, if you went to Robinhood or whatever and you look at the price of a stock, if that stock price goes into the floor, it's pretty likely that that company is not a token. That company with a stock had a catastrophic event, right? Like, why would the price just like plummet into the floor? Something horrible happened to that company. Whereas in reality, if you look at a token price for an early protocol, if it dropped into the floor, well, maybe it was just Sunday. Like, that's normal. But people don't think of it that way. They still think, well, wow, the token price dropped, that thing must be dead. Oh, the token price is high, this project must be ripping and like growth is incredible. Neither are necessarily true. It's basically a low source of information that people are accustomed to thinking of as a high source of information. So I think the extent to which you can smooth that token price and ensure that the market behaves in a less crazy way is supportive, because you don't want people getting the wrong idea. This is an early protocol. It's developing. We're trying to make it more mature, and we're doing our best. That's the idea, not like this is a roller coaster and you should get on. The third bucket of ways to distribute tokens is automatic programs. I already alluded to these. Security budget, like paying for verifiable high-quality work, paying for the supply side, all these things. These are basically ways that tokens are automatically issued by the mechanism in order to reward the types of things that you want. And then the last program, which is very interesting and I wish people thought more carefully about, it's maturing very quickly, is these manual programs. Everybody knows airdrops. Airdrops have some significant advantages and risks, but also some advantages. Retros, right? Retro PGFs, like Optimism has popularized. Grant programs, prizes, partnerships. These are basically ways that you in the early days and maybe a foundation later on, or maybe like the DAO members as things develop, can find ways to take tokens, do some work, out of band, allocate them in clever ways to potential partners. And I think if I could leave you one idea on this, because I'm out of time, is that we often think of airdrops, just because of the way crypto history has developed, as something you give directly to users, to end users. But I actually think this is a little wrong. Like, the Uniswap airdrop was, although it was to anyone who swapped and was an LP and whatever with Uniswap, just because of how early Uniswap was in its history, those are primarily developers. Those are just crypto native people who were likely writing smart contracts, building stuff. Just probabilistically, they were not a random sample of people. So there were some like regular people, but it was a very skewed set of people. And that is part of what makes it so impactful. And also recall that that was in the early days before the extreme professionalization of airdrop farming advanced. So I'd say when you think about manual programs, don't think as much about, or maybe discount slightly your ability to distribute it to regular people. It's very hard to do that in an effective way that is most valuable for them, most valuable for the protocol. Think more about how to get it in the hands of long-term stakeholders who are going to build on top of your protocol. Right? People who are leveraged, people who are going to raise their own money, people who are going to build their own business, people who are going to bring users because that's all they think about. Those are the people who are the most valuable to concentrate your scarce token toward for the long-term success. So I'm going to leave it there. Thank you very much.